Hello, Eleanor Beaton here, and welcome back to the Woman-Owned Podcast and to episode 4 in our 6-part series, Capital is a Verb. So this series is about one of the most important and least talked about topics in women's entrepreneurship circles, and that topic is capital. Women are taught how to generate money and how to earn money, but we are not typically taught how to deploy capital. If you want to build real economic power, long-lasting wealth, understanding capital isn't optional, it is foundational, and that's what this series is all about. If you haven't listened to the previous 3 episodes of this Capital is a Verb series, I strongly suggest that you go back and listen to those. And today we're going to be talking about how you manufacture capital, and very specifically, why revenue alone doesn't make you wealthier. Let's get into it. Okay, so capital is not money. They're actually different. Capital is money after thoughtful architecture. What the hell do you mean by that, Eleanor? So in this series, we've been talking about the fact that capital is a verb. And in our framework at Safi that we really work on with operators in our ecosystem, there's a 3-part, we call it the Jewel Capital Framework. And the first part of that framework is any wealthy person has to get their hands on capital to begin with, right? So you've got to manufacture capital. Some people inherit capital. Some people get capital from investors. And for many of the women operators listening to this episode, you are going to manufacture capital from inside your business. So the first step of wealth creation happens in your business when you turn revenue into surplus and you actually manufacture revenue. So a lot of founders think that capital starts when money just starts accumulating in the business, and that's not the whole story. Wealth starts when you are able to convert that capital that's accumulating into the business into an actual surplus. So again, this is about manufacturing capital. And how do we do that? We do that inside our businesses. Most entrepreneurs have been through periods in their business where maybe you spent everything that you made, or maybe you actually spent a little more than you made. And so maybe there was no surplus at the end of the year, or there was a negative surplus at the end of the year. So that can absolutely happen. What this episode is about is being strategic about where the money goes in your business so that your goal is to actually manufacture a surplus that you can then use to fulfill goals that I'll be talking about in future episodes of the show, of this series rather. Before we talk about protecting capital, before we talk about deploying capital or building long-term enterprise value and wealth, we have to start with the first movement in the Jewel Capital Framework, which is manufacturing capital. And one of the most practical ways to understand whether your business is manufacturing capital is effectively through something I call the margin stack. And the margin stack is exactly what this episode is about. I originally recorded a session on the margin stack months ago, and I'm going to re-air that episode here because the margin stack is how you manufacture capital. Here it is. All right, we're going to start with the problem that most women don't see. You may have had this experience that at the end of the year, you get your books done by your accountant, you get them back. You're like, oh, wow, my revenue looks great. I've got profit on paper. Why do I still feel broke? And this is really a big thing. It's a real thing. And so if that's you, keep listening. You may have experienced the trap of revenue growth without proper profit architecture. So you're growing your top line, you're growing your sales, but you don't feel like you have money left over. I find often a lot of service-based women entrepreneurs are actually optimizing the wrong metrics, or they're only paying attention to one metric, and usually that one metric is revenue. By only optimizing for revenue, sometimes you can be very wasteful and not actually build your business in a way that honors your energy and what you want to create. And when all of these things are true, the emotional experience is one of resentment, of exhaustion, of feeling like the business owns you. So I just want to really quick, before we get into the meat of the episode, I want to address why you're growing revenue, but you feel like you don't have any money. So here's what most people miss. Direct costs, so the costs to deliver your service and the cost to acquire customers, we'll talk about these in detail here in a second, they're variable, okay? So they flex with your revenue. But you have something called overhead. And overhead does not scale automatically, okay? So overhead is like your, many of the salaries in your company, they are overhead. A lot of fixed costs are related to overhead. And when your fixed costs are out of proportion to your revenue, or when your variable costs, your marketing costs, your sales costs are eating, or the cost to deliver of the consultants or contractors that you hire to help you deliver your service, when they're eating too much margin, you end up in this trap where you're growing revenue, but profit stays flat. So what we call jewel level scale, when you're growing, when you're following that 30-30-30 model, 30% growth, 30% profitability, 30% open time, this level of scale happens when you get overhead efficiency and strong leverage in your delivery model working together to produce net margins of anywhere to 35 to 40%, okay? If I were looking at your financials, I would not just be looking at your top line revenue and profit. I'm looking at the 4 cost allocations between those numbers because that's where the story lives and that flow tells me everything. So if I haven't lost you so far, let's dive into what those numbers are. So let's talk about the margin stack. Okay. Think about your business like a waterfall. Revenue comes in at the top. Yay! Profit comes out at the bottom. Let's go. Okay. And in between, there are 4 places your money flows through. These are 4, I call them cost allocations that either protect your profitability or erode it. Now, I actually have 5, but I'm special. So I'll tell you what my 5 are. But in general, there's going to be 4. Okay. So again, imagine a waterfall. The money that's coming in at the top is the revenue. Yay! The money that goes out the bottom is your profit. Okay, so the revenue and profit. In the middle are your costs. And these are the 4 places your money has to flow through in order to get to profit. So let's talk about this. So revenue, the 2 numbers that almost everyone looks at are revenue and profit. So revenue, of course, is your starting point. It's the total sales volume from all of your programs and services and offers. And that's the input. That is the top of the waterfall. And it's really interesting because if you look on social media, a lot of the big story is that the revenue is the output. That's the final number. It's not. That's just the starting point. And I think that's an important distinction. That's why when you see 7-figure launch or whatever, blah, blah, it doesn't actually tell the full story about the business. All it does is actually tell the starting point. Okay, so that's revenue. Net operating profit, net profit, basically, that's the output. And that is what is left after everything flows through. I know a lot of you guys do profit first. And so you're like, no, that's the wrong. Mike Michalowicz said. But basically, regardless, I don't care what Mike Michalowicz said. I actually do. I think he's a great writer and great thinker. But in general, profit is what's left after all of your other costs. And whether you take that out first or whatever, you still are going to have to allocate your costs. That's net profit. Here's what I would like to say. In service-based businesses, particularly coaching and consulting businesses, we have like profit guardrails, okay? Now, in traditional businesses, if your profit margin is, under 10%, your business is kind of on life support. If it's 10 to 20%, it's okay. If you have a 20% or more profit margin, it's a great business. A 30% or more profit margin, it's an awesome business. Like it's a jewel business, okay? So I think those are good guardrails. When I look at guardrails in a consulting-based business or a coaching-based business, I'm basically saying we at least want to get you a 25% profit margin. Under 25% for these types of businesses, I would actually consider to be a little unhealthy and we need to work with it more. 25 to 35%, that's decent profit. 35% is very strong profit, and 40% profit is generally jewel level efficiency. So that's like a jewel standard, right? Over 40% profit in a growing business is hard to maintain. And often it's not sustainable to maintain because you could be starving other parts of the business the growth that they need. These guardrails are very helpful. So as we said, under 20% profit margin for most of you guys listening, that's not a healthy business. So I would call that unhealthy, and we need to fix that. I would say that 20 to 25% profit is going to be, it's okay. 25 to 35% profit, that's strong profit. And like 40% profit is like jewel level efficiency. Okay. And again, there's no hard and fast numbers there. I have my own hard and fast numbers for my business, but I'm just sort of giving you some ranges for you guys to think about. The profit is what creates cash reserves. It's what gives you strategic options, and it's what gives you the ability to invest from strength. So this is very, very important. And the difference between revenue and profit, that is your costs. And this is where most people get it wrong because they're lumping all costs together, or they're lumping them in the general allocations that come from like Xero or QuickBooks or like typical accounting. And I just think those costs are garbage. So those cost allocations are garbage. They do not help you. So these are the numbers. I want to share with you the 4 cost allocations that actually tell the true story of your business. Okay, and I'm going to give you some keys to this. Okay, so number 1 are direct costs. So a direct cost is like the cost of goods sold, but in a service business, there's not often hard costs. But I want you to think, let's say you are a leadership consultant and you deliver leadership training programs, and you have contract leadership coaches that deliver, or full-time leadership coaches, or you have a client relationship manager, okay? Or maybe I'll take the client relationship manager out. But so direct program costs, these are basically the costs directly associated with you delivering the thing you sell. So think about coaches, facilitators, delivery contractors. If you host in-person retreats specifically to deliver on your events, it could be retreat costs. It could be program-specific software and tools. The key is you would only use those programs for it to deliver. So that is your direct program costs. Now, here's the key metric to watch here. In most coaching, consulting, and even a lot of service, your target is going to be that your direct program costs are 30% or less of revenue, meaning that you should have a gross margin on your sales of 70 to 75%. So whatever it costs you to deliver the thing that you sell, it really shouldn't cost you more than 25 to 30%. Like those hard costs should not be more than 25 to 30%. This, by the way, is why I see so many consultants who overpay the people who you are like the sort of fractional people, or the contractors that you bring in. You are overpaying them, and your business cannot afford to pay them as much. You're paying them their market rates, as an example. And so this is like something that we often see. If your delivery labor is eating more than 30% of revenue, you are going to have margin compression. You're going to have profit issues, and you're trapped in a high-touch delivery that's going to be very difficult to scale. What does this mean? It means every time you deliver, you're giving away too much of your revenue to the cost of delivering. And sometimes that's because your salary is in here, friend. And that means you'll always be the bottleneck because the model requires too much labor relative to the revenue it generates. Okay, can you see? So this is where programs that we've run, like the 500K offer, really starting to systematize delivery as much as possible, starting to break it apart so that you can train people in how to do what you do. These things are so key because they help you get control of your direct costs in the service-based business. All right. So sometimes we'll work with consultants who are they might, let's say they got $1,000 to do a project. This is never actually the case. It's more like they got $100,000 to do a project. They have a consultant come in and do the work, and they pay that consultant $60,000, i.e. their direct costs are 60%. And they think they're getting a great deal, but what they forget is they're still trapped in delivery. the markup is not high enough in order to be in business. So if this is you, you should contact us, by the way, and we can help you make the shift here. But that's direct program costs. So again, you don't want, when it comes to costs, your direct costs should not be more than 30% in a traditional consulting or coaching or service-based business. Okay. Now let's talk about customer acquisition costs. This is the next bucket. Customer acquisition costs, this is like how much does it cost you to get a customer? This is very specific. Let's say that you have a social media content creator. Is that person's salary in customer acquisition cost? Hell to the no, because they are not actively, immediately involved in getting customers. So what goes into customer acquisition cost would be paid advertising. If you have a sales team, your sales team compensation and commissions. If you have contractors like an ad manager, or you are doing a virtual launch that ties directly into the sale of something, that launch manager, only for that, their salary would be included here. And and that's basically it. So we're talking like sales and advertising and only specific costs that related directly to a sales event. Okay. So that's customer acquisition cost. You generally are going to want this to be, it's often going to be 15% of revenue. This is like really important. So the key metrics to watch here are a payback period. So how long does it take you to recoup what you spent to acquire a customer? Every different company is going to have a different payback period. We often say for sure under 12 months, but of course you'd want to be able to retain your customers. An important ratio here is the ratio between lifetime value and customer acquisition cost. Okay. So the lifetime value of a customer should be at least 4 times what you spent to acquire them. And for many of you, it's going to be many, many more. That ratio is going to be much bigger. But I think this is like quite important to think about. That's how you can grow without growing broke. But generally, we want to see a target of, 15% of revenue, 15% of your costs of revenue is for customer acquisition. Now, it's interesting. I actually often find that many women-owned businesses really underspend here. That said, if customer acquisition creeps above 20%, your business model may be really challenged, and you may be spending too much to acquire customers relative to what they're worth. Okay. So what does this mean? You might have a positioning problem. You might have an offer problem. You might have a conversion problem. And if this is you throwing more money at ads won't fix this, you need to fix the underlying economics. So that's another thing that I'm going to be looking at. Okay. Now let's talk about overhead. Oh my God, overhead. This is where there's just so much bloat, and it can be really hard. So overhead is kind of like you've got your direct cost, that's the cost to deliver the thing. Then you have your customer acquisition, the cost to get the customer, and then you have overhead. So let's talk about what overhead actually is. So overhead are baseline operational costs not directly tied to program or acquisition. Okay. So this is going to be your accounting, legal. If you have a CFO, it would be that. It would be all of the tools that you use. So if you use Slack, if you use Zoom, that kind of thing, your payroll software, general operational contractors, if you have bookkeeping, if you have HR, it would be a lot of your team. So overall client experience would be in here. Anybody who has an operational role would be in here. Any of your general marketers. So if you have like a social media assistant, they would be in here. If you have a marketing assistant, they would generally be in here. And that's like actually quite important because a lot of these costs that you're taking on are actually overhead. Professional development is in here. So that's overhead. Okay. And the rule here, so typically you're not going to want to see overhead more than 30% of your revenue. Overhead has got to scale slower than revenue. And as your revenue grows, your overhead should become a smaller percentage, not a larger one. Okay. So sometimes if I'm working with someone and their overhead costs are too high, the answer is actually to grow revenue more. It's not always to cut costs, but it can be. It just kind of depends. So if your overhead exceeds 30%, the worry is that you might be in profit erosion territory. And honestly, this is where most businesses bleed. And I've done this. They hire too fast or they build infrastructure before the revenue supports it. And that is a big issue for companies. And what this means is that you've built an expensive machine that your revenue can't sustain, or that you're working harder to feed the infrastructure than the infrastructure is working to support you. So when this is the case, again, we want to go in here and we can usually pretty quickly see if this is the problem based on the cost analysis that we're doing. Now, I have another category, which is events and travel. And this is its own category because it's not a part of marketing. It's not a part of customer acquisition. It's not a part of overall overhead. It's not a part of customer acquisition costs. It's not a part of direct program costs. It's sort of a bunch of that stuff all together. So in my allocation, I have speaker travel, conferences, brand building events, ecosystem plays, that is all in events and travel. And this is discretionary spending and it's coming out of profit, not necessarily baseline operations. And I generally invest here when my profit guardrails are met. So I would not make investments in this if profit were under 30%, by the way. Okay. And I did not have 3 months of operating expenses in reserves. That's where I'm at. Okay, so this is a strategic investment, not a cost of doing business. If you're spending on events and travel when your profit is under 30%, you're borrowing from the foundation to fund visibility. And if you're doing that, you need to be doing it consciously. And I think this is the thing, right? I'm giving you guys guardrails. And the guardrails are not to see how perfect you're being. The guardrails are to help you give at least a bit of a baseline. So if you're not at these baselines, you know what I mean? I'm going to go back and revisit them one more time. If your profit is under 20%, right? We know that we want you to hit 30%. That's kind of the Joule business model, and true Joule efficiency is when you're over 40%. That's just a freaking amazing place to be. More than 40%, you may be underinvesting in other parts of your business. So we look at direct program costs or direct costs associated with delivering your service. And we love to see these at no more than 25 to 30% of your revenue. Customer acquisition cost. We want to see this basically around 15% of your revenue. Overhead. We want to see this around 25 to 30% of your revenue. And then events and travel, once you've met your profit targets and you have operating expenses in the bank, then we'll typically use this 5 to 10% when used strategically. Okay. So these allocations, these sort of guardrails are not to be oh, you passed, you failed. I just find it when I have an idea of what I should be aiming for, then I can start to make the changes. And I want to be very clear with you that I have gone through years in my business where I wasn't my numbers were out of whack. And I patiently made the shifts to get them into whack. Okay. So this is disciplined leadership. First, get your book set up properly. 2, start looking at them for Pete's sake. 3, identify where things use them to help you understand what's going on in your business. And if you can't do that yourself, you should reach out to us. And then from there, we can take a look and start helping you understand and internalize this information and use it to make strong leadership decisions about where to focus your business. So how to use this? What I would do, and again, most of you won't have your cost allocations set up like this in your books to begin with. So now that you know what they are, I would pull your P&L for the last 3 to 6 months, and then I would start mapping your actual costs into these categories: direct costs, customer acquisition costs, overhead, events, and travel. Calculate each as a percentage of total revenue and compare your percentages to the targets. Look for where you're bleeding. And for most of you guys, it's going to be overhead or delivery costs. And then ask yourself, if I could fix only one of these ratios, which one would unlock the most leverage? Where am I out of alignment with these targets, and what is that costing me? Okay, so I want to share some common patterns that I see. So one is that many of you guys have a very high touch delivery model with direct costs that are over 40% of your total revenue. This means you're trapped in delivery and cannot scale. Period. Right? And so that's where your model must change. It's got to shift, my friends. And it doesn't have to be dramatic. but it's going to happen. Number two, I will see overhead bloat from hiring too fast. And this means you're then working to feed the team instead of building profit. Sometimes I will see customer acquisition cost creeping up because you're throwing money at ads in order to try to solve a positioning or an offer problem. And so your acquisition costs spiral while conversion stays flat. And alternately, sometimes I'll see some of you guys are spending nothing on customer acquisition because it's all going into delivery, right? And then you're wondering why you're having a hard time scaling. And then sometimes I'll see you guys spending on visibility and events like fancy photo shoots and all this kind of bullshit when profit margins are already fragile. And so you're borrowing from your foundation to fund your brand. And that's not smart either. And it's not that any of these, and please know, I've done all of these stupid things. By the way, I call them stupid, so harsh. I've done all of these things, and there's no spending that I think is bad spending. I just think you need to be aware of what you're doing. And if you are borrowing from your foundation to fund your brand, know that. Be friggin' clear about it. Be honest with yourself and understand the stress that puts on your business and suck that up, and be a leader about it. I think sometimes the problem is when we don't have these conversations, we don't know, we get into trouble. We don't know why. We don't even know that we're in trouble. We don't even know what to do, right? So I think that this, we so rarely look at this through the lens of money, and money is such a powerful lens to look at your business through. So when you understand their margins stack, everything changes. Number one, you stop optimizing for vanity metrics like revenue, team size, follower count. And it's not that any of those numbers are bad. It's just that alone, that's not a healthy business. Number two, you start making decisions like a CEO who actually understands business value creation. You can finally see why you are often exhausted even when revenue is good. You start to gain the vocabulary to have smarter conversations with your CFO, your bookkeeper, your financial advisor, and you know exactly where to focus your energy to create the most leverage. So I think the identity shift that I want you to make here is not just I'm a consultant, a service provider, a fractional this, whatever, who's good at what I do. I'm a business owner and CEO who understands how to architect profit. And that will change everything. All right. I hope you enjoyed this episode about why revenue alone doesn't generate capital and how to use the margin stack framework to help you manufacture more capital. If you haven't taken the capital strength assessment, I strongly encourage you to do so. It's a really nice companion to this series. You can access it at safimedia.co/capital. That is safimedia.co/capital. Thanks so much for being here. And next week, we're going to talk about protecting capital. Don't go anywhere. Thank you so much for tuning into the episode. If you found value in what I shared, please go ahead and like this video, give it a thumbs up, and leave me a review or leave a comment below. And don't forget to subscribe. Thanks so much for being here. We'll see you next week.